Bruce, welcome back. And Roman, welcome to the show.
Thank you.
Thank you so much.
Excellent. Well, Roman, since we haven't had you on the show, maybe you could tell us a little bit about your background and how you know Bruce.
Well, first of all, thank you, Tom and Aaron, for having us and giving Bruce and I an opportunity to promote our charting show. Bruce will be talking about the show a little bit after I'm done. I'm also really grateful to Chip, Grayson, Zach, Danville, Gretchen, and the whole Stock Charts team for setting us up with the show. And I just always love working with Stock Charts team. They're just really, really great professional people. A little bit about myself. I'm going to start with my first trade, my first ever trade. I've conducted my first trade about 22 years ago. It was in the pound dollar. And at that time, I had an e-signal box with the manual data switch. So that just tells you how long ago it was. And I was trying to just do a momentum play without any of the charts. So I was looking at the quotes. And as I saw the quotes, showing some kind of momentum, I was trying to get in on the trade and just follow it. By early morning, because on the West Coast, it's really throughout the night that you trade Forex markets. I was sweating, I was having an anxiety attack, and my first trade resulted in a significant loss. And I had to cover a margin call. Can you imagine on that first trade? And that was probably the most profound and most important trade of my career. Because being a human, I had to emotionally survive that uncertain environment. And therefore, I decided to just study the trading in depth as much as possible. And that led me to Golden Gate University and Hank Pruden. Excuse me. I still remember how I came to Hank's office and how he was showing me the charts, the Wyckoff charts, and I was instantly hooked by his story. I've taken all of the Wyckoff classes a couple of times from him, and all of the technical analysis classes, and this is where I met Bruce. I was a really good student, and Bruce probably can attest to that. I was reading so many books on technical analysis, studied so many methods and strategies, backtested a lot of the stuff. And I've realized that Wyckoff methodology is probably something that I'm really comfortable with, that works for me. And then in 2010, Hank invited me back to Golden Gate University as a guest speaker to one of his classes. And that single presentation has changed a trajectory of my career. And Hank had that type of effect on people. He asked me to teach a 5 through 58 class, which is the class on trade execution and implementation. Then he suggested that I would teach 2 of the online Wyckoff classes, a 5 through 54, a 5 through 55 class. And then throughout the years, I worked closely on different projects with Hank. Together, we've created the online technical market analysis curriculum for Golden Gate University. We went through a great experience with the IFTR 2013 International Conference. He involved me into the TSASF, which is the local Bay Area technical analysis organization. I was the president of that organization for quite some time. I was also an IFTA board member and a member of the educational committee there. At the same time, since 2010, I've been developing my own teaching and consulting business, WyckoffAnalytics.com. WyckoffAnalytics.com is a very thriving Wyckoff community with fully developed educational curriculum. I've taught technical analysis and Wyckoff trading classes to probably thousands of people now, thousands of traders, and I've done it by myself. I've done it with many teachers like Bruce, and I'm really grateful, to have that experience, and to continue with my teachings. I always say to my students that if trading is my craft, then teaching is definitely my passion. My trading style is just unique to my mental landscape. I've been searching for my trading identity for quite some time, And I'm really comfortable to say that I'm a speculator. I'm really comfortable trading any instrument in any time frame as long as the trade presents the best opportunity in the current markets. I'm looking for trades that produce the fastest and most profitable results with the relatively low emotional maintenance for me. I'm really happy to be here today for a couple of reasons. The first one is just to promote power charting with Bruce. And then the second reason why I'm so happy today, and maybe you guys appreciate this. After conducting over 200 classes and presentations in 2018-2019 school year, which started last September, this is my last today. I mean, this is the actual last day of this summer semester that I have. I'm literally sitting on my bags, and tomorrow, I'm flying away to my vacation spot. So there are only 2 sessions left today with Bruce, this one, and then WMD Wyckoff market discussion session at wyckoffanalytics.com. For anybody who's interested, just feel free to look it up. So I'm a happy camper today.
Well, Roman, welcome to Power Charting.
Oh, yeah, thank you.
It's a huge thrill to be able to not only have our Power Charting show, but to have you as my co-host and to do this together. And I want to attest to the fact I've been doing webinars and teaching in the classroom with Roman for a number of years now. And I want to say that Roman is a true, using a baseball analogy, 5-tool player in Wyckoff methodology. And you can sense from Roman that the emotional aspects, the mental aspects of trading are very important. We have both taught classes at GGU on this subject. I'm sure that you're gonna find over time that we're gonna weave that in. And so, Roman, it's very exciting to have Roman doing this program with me, and we're going to have a lot of fun every week with this. And the emphasis of the program is going to be to identify stocks using the scooters as a methodology, a screening methodology, and then identify these different stocks and different aspects of their where they are in their scooter relationships, and then evaluate them with the Wyckoff eye. And so that is going to be our mission, and we intend to use this as a framework to teach Wyckoff. And so it's going to be hands-on. It's going to be case study methodology, which is what we learned from Hank, was to teach with a case study method. And you're going to see that we're just going to keep, going over these different charts and going over the principles over and over again. And through that, we're all going to get better and better at Wyckoff. So, Roman, why don't we take a look at some charts?
Sure.
So what are we looking at here?
So our first chart is just the market, S&P 500, and we thought that maybe this is a good, start for us on this show, just to talk about the market in general, the market in comparison, to other markets, and then to give you an example, maybe of one stock of how we look at things. So, Bruce, what I'm looking at here is a very predominant trend that we had in 2017 going into January of 2018 into more of the climactic run. We see a lot of velocity increase, momentum increase on the last swing to the upside. The spread is increasing, and that results in the buying climax, stopping action. After that, we're seeing a lot of change of character. Change of character is a very unique, a very interesting concept. It basically tells us that we are shifting from one environment into another, from in the environment of the uptrend into the environment of a trading range, of a consolidation. And it's during the consolidation that we have to decipher what kind of buyers we could possibly have for the price coming out of this this consolidation. The move to the downside, which was very aggressive on a lot of increase of the volume signature, a lot of supplies coming in, has a stopping action of its own. It's a selling climax. It also has a localized test, which still has a lot of supply behind this. Usually this type of action suggests that there's going to be some kind of retest further down the road. At the same time, a really good rally, not necessarily retesting the buying climax high, but showing that there is an ability to rally, suggests that the next test is probably going to be successful. So at the secondary test, we have multiple points where the price has tested the support area, and we've seen that by the last point of support, where we are registering a high low, we're also observing the volatility contraction and decrease of the volume signature, in general, decrease of the supply signature. That suggests some kind of rally. And these are usually the places for us where we're going to start thinking about opening the positions, where we're going to start thinking about the selection, where we're going to go through the selection algorithm of what we're going to trade for the next move to the upside. A couple of higher highs, which we would say they are forming a minor sign of strength. The price still within the larger formation here, but all of the reactions to the downside are actually quite manageable, and they are within the context of the uptrend that we have. A minor backing up action suggesting a continuation to the upside. And Bruce, let's discuss this last action right here at the on the right of the chart. What are you thinking about the price and the volume signature here?
Well, the thing that's we're most concerned with is that we see a lot of resistance that is has formed very early in this change of character. This one of two things is going on here. This is either a reaccumulation or it's distribution. And so we can see from the analysis putting in overhead resistance lines that we have an area of resistance in the S&P, and we're just above it. And this actually is a very important place because this is a danger zone, because resistance we drew this at the upthrust action, that this resistance level is a place where large interests, large informed money managers will step in and supply the market with stock, meaning that they're selling. And so what we want to test for here, now that we're all the way from the support line, we've rallied all the way up to resistance, whether or not we have a failure back into the trading range. And so that is something that we're really looking for. We're watching these bars day by day to identify them. The good thing that happened in the last few days is that we had a backup, and this backup occurred on a lot of volume. And so those two little red bars in their very tight range days with a high volume, which we would interpret that as being potentially a good sign, because it's a sign that this supply that showed up here is being absorbed. And we had a pivot and we've turned back up. So now what we want to see is we want to see follow through. So you can see all this trading in here, this congested trading where there's been a lot of choppiness, has been an attempt to absorb the supply that is overhanging the market up at this resistance area. And then the next stop is the high of the buying climax. And that area is going to represent some resistance also. And so these are the things that we would be studying. This is not the place that we would initiate trades on the long side. This is not a place where we would buy. We would tend to buy on the backups and the last point of support and the secondary test. Those are the places when we get turns off of those areas where we're looking for good entry points. And so the other thing, so anyway, I'll leave it at that for this moment, but Roman?
Yeah, I really like this area right here because it's a little bit trickier. And usually, whatever is tricky actually, attracts my attention. I think that we've been calling the market actually really nicely, especially since this area right here, it showed a lot of absorption in the way how the price was moving up, in the market. suggested that there are quite a lot of trading opportunities right there. You just had to be a little bit more selective than the area, of the rise in 2017. Now, this specific area suggested that maybe there is some kind of deterioration of the demand. So demand was becoming of poor quality. And it's probably more associated with the selection process, for the institutions. They are more selective now than they were in 2017. So one of the thoughts that I had here around the area of the resistance is that we're probably going to come back, at least to the area of the support. And we did not. So what does this tell us? That tells us that whatever supply is trying to come in is, this supply is being observed. And the point that Bruce made here on the increased effort to the downside, we are not having result increase in the direction of that effort. So there is no synchronicity, there is divergence between the effort and the result. And that suggests absorption and possible continuation. Now, this yesterday bar was very interesting because it upthrusts, it tries to commit to the upside, it actually does so. And it has some effort behind it. So we know that some supply is coming in on that particular bar. Yet, today, we are actually absorbing that supply. And I think that today's action is actually quite positive. So I wouldn't be surprised if we would try to continue to the upside and actually try to retouch the buying climax high. Bruce?
Absolutely. And so we're always testing the market. These are very Wyckofian concepts, and we go over them and over them and over them. And it's real-time analysis where we're looking at it bar by bar. And this is what we intend to do in power charting. And here we're looking at the S&P 500, but we'll do a lot of work in individual stocks. And we'll use the scooter rankings to identify candidates to analyze. And this is going to just be a lot of fun. So, Roman, we have a little bit of time left. Do we have some other charts?
How much time do we have left? I thought.
I think we have like maybe 10 more minutes.
10 more minutes. Okay, so we have 2 more slides. Yeah.
And we want to maybe take some questions too. So.
Oh, okay. By the way, I really liked your definition there of the danger point zone. That was great. Thank you, Bruce. All right.
Well, that's why we do this together.
Yeah, so, I like that. Okay.
We've done a lot of teaching in the classroom together. So yeah. we're like a couple of old shoes. We're just like
but that was something together. I haven't heard this from you before.
Oh, okay.
All right. So, Bruce, we're looking at all of the 4 indices here: S&P, Dow, Nasdaq, Russell 2000, which is the IWM, the Russell 2000 ETF. What do you see here in terms of the performance of different indices? What is outperforming? What is your view on comparative analysis?
Well, the two lagging indexes really are the S&P 500 and the Dow. And I think that the Dow is particularly interesting because it is way behind how the other indexes are performing. And I believe that the Dow might be sort of the key arbiter of what's going to happen in the market as a whole. And that sounds kind of strange because it is the laggard. But here it is right now up against important resistance. And Roman, just show them the climax, the selling climax in the automatic rally. This is such an important concept. And this is just worth the whole day is when you can get identify the selling climax in automatic rally. Now you have the low point to draw a support line and the high point to draw a resistance line. Now, look at how well the Dow Jones confines itself within the boundaries of support and resistance. And this is such a valuable concept. And here it is back in early February saying this is where this market's going to trade for the next 6 months or more. Who knows how long it's going to be up here. But here we are, we're at resistance. And I believe that this is a very important place. A couple of things that have happened. One is that when it declined down towards support back in June, you can see that it was unable to get all the way to the support line. Well, that is in of itself is a measure of success or strength. in that it was able to do that. Then it formed a little like mini accumulation there where it paused and then turned back up. Now it's pushing up against resistance with a reasonably good rally. Well, so this last decline might very well be a last point of support. And this is a term that we use. It's a concept where we would actually enter trades into a last point of support or on the turn off of that. Well, now that we're up to resistance, what we really need to see from the Dow is the capacity to jump here. And you can see that it tried to back up. It stayed very close to the resistance area and has held firm, and now it's knocking on the door. So what we want to see is we want to see a good jump up and then an ability to be able to stay in the range of this resistance line and potentially stay above it. And the best of all conditions would be that it just runs away from it and goes right up to the prior highs at the buying climax. So I think that the Dow is sort of the litmus test here. Ramon?
Hey, Bruce. Ramon,
yeah, sure.
You know, this is very fascinating, and thanks for going over all these different indices. I think this is really very educational, and you know, the marks that you made on the Dow and the fact that it stayed contained for so long, that has been pretty fascinating to watch. Does it change your opinion at all when you're looking at the Dow, when you see the NASDAQ break to an all-time high, the Russell 2000 break to an all-time high, and the S&P break above that reaction high in March? Does that give you more of a feeling that the Dow is going to make the breakout, or does that not matter to you all at all?
Well, in my mind, well, first of all, the instruments that we're trading are going to be in the leadership. So we're focused on the NASDAQ, we're focused on the Russell, and also the leadership stocks in the S&P. So throughout this whole period, we're identifying where the leadership is, and and just staying with those. And you can see, especially in the Russell, that it's just had such a good uptrend. And I have sort of a comment on the Russell here in a second. But I'm just thinking of the Dow as more of a litmus test. And I actually believe that this is very encouraging for the market as a whole, that these other indexes are stronger. My cautionary note would be, look where they are in their trend channels. And so they are pushing up against the top of their trend channels, which means that by in a Wyckoff definition, they're overbought. So that doesn't mean that they have to go all the way back down to oversold, but it does mean that they may need to pause here. And so it's interesting that everything is kind of pushed up against overbought here, and the Dow, which is the laggard. So my feeling is that if the Dow can jump up and out, that it might actually give cover for the NASDAQ and the Russell to rest, and the action might come in the Dow stocks or the Dow type stocks. And so the Dow might become leadership in a sense for some period of time. And that doesn't mean the NASDAQ and the Russell have to be in any trouble. They just may consolidate. So that's sort of the way I'm looking at it.
I would agree with this, and kind of like Tom led with this question, I was actually going right into that point. There is a little bit of the rotational story that we see in the most recent, 2-3 weeks action. We kind of could see that the Dow right here is starting to outperform the Russell and NASDAQ. And I think it's probably related, to everything what's going on with the trade talks and with the tariffs, because this whole change of character that we've experienced in after January and February is most likely related to the uncertainty that institutions experience with everything that's going on with the trade talks and tariffs. And obviously, the big multinational companies are going to be experiencing, some doubts as to what's going to happen, to their revenue stream. Whereas the smaller companies or the technology companies are, less prone to this type of reaction. So lately, we're seeing a change, a rotation, between the leadership. So that gives us a very interesting technical clue on the fundamental data that is coming in, from or macro data that's coming in, from Trump administration and the whole trade talk. So very good point, Tom, and you're just catching up this rotation pattern right here.
Yeah, and I would also add, if I could, the dollar index, which, you know, had been on the rise since earlier this year, has kind of hit a key resistance around 95. And the rising dollar also rotating into the smaller companies, as a lot of the S&P and stocks, of course, are multinationals. And so their foreign profits are being brought back in with a, you know, more expensive dollar. And so they're getting some negative currency translations there, which I think has been impacting the market as well. And that kind of goes along with the whole talk about the trade and tariffs and so forth. But my feeling is that after this is over, I expect the dollar is going to go higher and that the Russell 2000 will break out. And it's, I guess from your perspective, you want to see it first. Is that correct?
With the Russell specifically, I think that we're going to be confined within this range right here. The way how the last 2-3 weeks are unfolding, with multiple attempts to retest the resistance to break out, you know, all of them have failed. And specifically yesterday, you know, some supply is coming in. So I would be saying that the leadership that the Russell has had for quite some time is going to be short-term, temporarily not there, and it's going to go into the consolidation. And that's why I think Bruce is saying that, you know, there is a much better chance, let's say, for the S&P and the Dow, you know, to overcome this resistance. And I think technology is just a very specific case here. You know, we have to be selective a little bit with the technology, but it's probably a safer bet, you know, with everything else that we look at in the markets.
Yeah, point very well taken. Aaron, I know that there was a question in the room.
Yes.
So that gets asked. And
yes, there was one for sure that.
And we have one more slide after this, by the way, guys.
Okay, go ahead, Aaron.
Okay, no problem. Okay, so you know, the question is, does time factor into Wyckoff analysis? Is there certain time frames? Can it be short term? Is there long term, or is it sort of like a point and figure?
Bruce, do you want to take that?
Wyckoff is, as a matter of fact, at the last Market Watchers Live that I was on, I actually focused my discussion on intraday analysis with Wyckoff and demonstrated that the principles are at work in the shorter time frames and in the longer time frames. And the point and figure works. I've written a number of blogs using intraday data for point and figure and very long-term data for point and figures. And so the vertical charts and the point and figure charts really work well in multiple time frames. And so it's a great tool no matter what. As a matter of fact, I think you can go back in the on the Stock Charts TV channel, YouTube channel, and I think you can find that discussion from last month. And so it's sort of a nice introduction.
Excellent. Did you have a question, Tom? Because I know somebody was asking about a stock in particular, but I wanted to make sure all the general questions get in.
Well, let's I know Ramon said he had one more slide, so let's go ahead and take care of this one first.
Perfect.
All right, Bruce. So we're looking at the Honeywell here. Why don't you start with your analysis here?
Well, Honeywell, we don't have a lot of time, so I'll just make some brief points. This is a reaccumulation structure. So there's accumulation structures which occur after long downtrends. The S&P, the indexes we just looked at, are what we're hoping are reaccumulation structures, where they, after a long uptrend, they pause and rebuild point and figure count and rebuild for another run, another move up. So Honeywell, looking at this, we're looking at this as a reaccumulation structure, and you can see that after a long uptrend, it had a change of character, climax, and then sell-off. We're calling that a selling climax, and now we're in a reaccumulation. The whole point of Wyckoff is to identify that, in fact, the large interests are reaccumulating or absorbing the shares of the stock. The stock cannot go up unless it's in strong hands. It's that simple. So we're identifying the evidence or the footprints of strong hands accumulating shares, and we want to see that nearly complete before we step in and then take the ride with these large interests. We want to go with them. And so here you can see just in conclusion, you can see this phase C. And the way that Wyckoff looks at charts is that they have to go through a process. They have to go through a stopping the decline, and then they have to go through a period where stock goes from weak to strong hands, and then you have the final testing. And now that the stock is in strong hands and it's very hard to buy in quantity by institutions, it starts to move up easily and effortlessly. And so our intention is to get on board when that is ready to happen or is happening. And this is what we call phase C. And we develop our Wyckofian eye to identify these phase C scenarios, phase D, which is the beginning of the markup out of the trading range. And so this is what we're looking at here, Ramon.
Well, one of the things that I want to give you guys in this presentation is that think of the phases as segments in the trading range, and think of the segments as the areas where the testing of the supply always happens. So we have the first area, the first segment, where supply is very dominant, and it's very aggressive. You could see this from the price signature, the spread increase, the violent moves to the downside. And then look at how volatility starts to decrease as we go into the second segment in phase B. And then phase C, third segment, third test, has the lowest volatility. The spread is small, and then we have kind of this grinding up action, which is an absorption on the way up of the supply that is still remaining right there. By the way, we're going to talk about the scooters a lot, in our power charging program. Look at how the scooters break out and the price breakout out of the short-term trading range confirm each other. And actually, one of the positive things is that, the long-term or, maybe intermediate-term high is also confirming both on the scooters and the price. Bruce?
Perfect. I think we should leave it there. It's, I know we're nearly out of time.
Usually we are so, behind the time. We usually spend more time, but now we're on time. That's great.
The faster we go, the behinder we get.
Awesome.
Yeah. So
I know you're going to head out here in 1 second, but I do have one chart I want to go ahead and share with you, if you don't mind, and just get your quick and dirty 30-second opinion on.
Love to.
This is the XLF on the financials. And so here's the chart where we had the move up back in January. Here is that selling climax. We had the reaction high back up around 29.5. You're going to love this, Bruce. I mean, I'm actually getting into this Wyckoff stuff here. As we made the breakout back above 26.5, you can see that actually is pretty good price support coming in here as well. And my question is, and I know you've talked about this before, when you have these reaccumulation zones, sometimes you'll get a spring where you get this false breakdown and then start to turn back up again. So my quick question here is, if you were looking at the XLF, do you believe that that's a spring? Would you be a buyer of the XLF here?
I would treat that as a spring. And it's a great example, and you have a really nice change of character. Look at how after the spring, it fails to go down. So the key with a spring is when it springs the low, does it keep going? And so it doesn't. It can't get ahead of steam. Look at all the volume down there. Well, that volume is actually, there's a lot of demand in that volume, and it's keeping the price from breaking down. And so this actually encourages the large institutional interests to keep buying. And look at the nice change of pace as it turns off of that and just starts to go up. And it's just, marching up. And the rally is better than the rallies that preceded it in the trading range. So this is really encouraging for the banks, for the financials as a whole. As a matter of fact, in my last blog, which I just published on Monday, my blog was about JP Morgan and about the larger discussion about the financials and have they put in a spring and are they ready to lead again?
Yeah, here's that JPM chart that you were talking about, taking out those prior lows, coming down here, heavy volume, and then look at that rebound. This actually, JP Morgan's not far from a breakout, which is really encouraging given how the selling that we saw earlier this
and
year.
I think that's encouraging for the whole market, is to have these financials acting so well.
No doubt about it.
Yeah.
Well, Bruce, Roman, it was it was really great to hear from you. I know everybody was fascinated. We were fascinated watching you go through this. Just want to remind everybody, Fridays, 3 p.m. Eastern Standard Time, power charting is now going to be on. And if you liked what you saw here, you definitely are going to want to tune into that. Appreciate it, guys.
Thank you. Thank you both. Take care.
Volatility is back, interest rates are rising, and the markets are headed into uncharted waters. As uncertainty grows and the tides begin to change, you need to take action. ChartCon 2018 is here just in time, with an all-star cast of investing experts and industry-leading technicians. Watch live as these pros share their charting wisdom and guide you through their strategies for finding success in any market. Your registration includes 2 days of insightful, exclusive presentations from 15 investing legends, plus complete video recordings to watch on demand for years to come. Stream ChartCon live right from the comfort of your own home or office. No need to travel, no need to break the bank. See how the experts are protecting themselves from market volatility and reducing risk in today's uncharted waters. Join us at ChartCon 2018, streaming live August 10th and 11th.
So in the book itself, just so everybody knows, it's all stock charts, it's all stock charts, setups, but I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. A lot of it is about the settings in stock charts and how to make great charts. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. I think it came out pretty well. So in the book, what I try to do is show how to get things set up, specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. With that, thanks everybody.
This is a brief tutorial on using stochastics. Big word, but wonderfully simple. The idea behind stochastics indicator is that as the price moves up, the close tends to stay close to the highs, or the price action throughout the day tends to stay close to the highs. And as the trend weakens, it has trouble staying near the highs. The stochastics will point this out. And the reverse is true at the lows. So as price is declining, all of a sudden it stops always closing near the lows. So not to get confused with %D, %K, %R, that type of thing, Henry Ford started with the Model A and went B, C, D, E, F, G, all the way through to T until he came out with the Model T Success. And so when George Lane and his colleagues were doing that for stochastics, they kept working their way through, and they did the same thing. They used %A, %B, %D to try and find a rhythm that worked out nicely. So what stochastics does is it takes a range over the last few days, in this case a 5-period. Stochastics would say that from this point to this point is 100% and price closed at 82%. And then that would be %K, and then %D would be a moving average of that. And it's important to remember on stochastics, according to George Lane, there is only one valid signal, and that is the divergence on %D. So you're looking for the divergence on moving average, and I'll show you that on some real live examples. So here's Apple, and I've got these stochastics set up slightly different. So this is a fast stochastic, this is a slow stochastic, and you can see that it's much smoother. It's got these whipsaws taken out, and that smoothing function is what %D is changing for us. And then the full stochastics here, I've changed the period to 14 instead of a 5-period stochastic, just to show you that it gives you smoother signals, and so it's a little easier to trade with a 14 period, and that would be the default at stock charts. But depending on how aggressive you want to be, you might find that there's a better way to trade. So all of these signals are important, but what the big clue you're looking for here is this positive divergence where things are improving while the momentum is coming down, and you're starting to see the stock whipping around at the bottom here, usually a sign that something's getting a little more volatile and you might get a chance. So, you know, a nice trade like this would be a great move of $30 or something like that, and it would have got you in relatively early. Here is USO, and what we want to show you on this particular area is you can see how the price is actually struggling to make any moves higher. And even though percent K keeps banging on the top here, the percent D, which is the moving average, this purple area, is moving down and making a lower high here. And it's that lower high that is our divergent clue that we want to be aware of. And then that's going to give us our sell signal. And in this case, we've got double divergence with another lower high way over here. And that is a real clear signal that George Lane likes to talk about. When you get those, it's a very valuable signal. So you're looking for the divergence on the moving average. And again, in this case, I've set up all three as 5 period moving average, but our default is 14, so you could set them up whatever way you'd like. And the way you do that is just select them from the drop down menu in here, and then pick the time period that you want.
I want to show you a little charting trick that I like to use for the percentage price oscillator, or the PPO. On this SPY chart here, you can see in the indicator windows I've got 2 PPOs. The first is the traditional PPO. It's the black line there, and that's the difference between the 12-day EMA and the 26-day EMA. And you can see it's above 0 when the 12-day EMA is above the 26-day EMA, and below 0 when the 12-day EMA moves below. The red line is the signal line, and it's set at 9. So it's a 9-day EMA of the PPO, and you can identify downturns and upturns in the PPO with that EMA. And the histogram is the difference between the PPO and its 9-day EMA there. You can see when the PPO is below its 9-day EMA, the histogram is negative. And then when the PPO is above its 9-day EMA, the histogram is positive. Now, the little trick I want to show you has to do with the PPO 50, 200, 0. That's the second indicator there. And what I've done is I've eliminated the signal line by putting 0 as that last parameter. So this PPO shows the percentage difference between the 50-day EMA and the 200-day EMA. And you can see that it shows as a histogram when using these parameters, and it has been positive for over 6 months, actually for over a year, actually for over 2 years in this chart. And we can see that it's currently around 3.1% difference. That means the 50-day EMA is 3.1% above the 200-day EMA. And we can confirm that by going to the annotate button there and choosing percentage change. And if you measure the percentage change from that 200-day EMA, the red line, and I go up to the 50-day EMA, there you can see we're about 3.1% difference. And so that's what the PPO is telling you. And so I like to use that longer term PPO to get an idea of the long-term trend.
If you're interested in trading Alexander Elder's Come Into My Trading Room or Trading for a Living book, we have the settings on stock charts to do that. First of all, the Elder candle style. Then you could use Keltner bands to set up the width. These are adjusted based on the ATR, and the force index, of course, as well as his MACD, or the regular MACD. So here's how you do that. You'd select Elder Impulse System from the drop-down menu on Chart Type. You'd select Keltner channels and pick the width that you want, and it has to be one that fits nicely, and then force index and MACD. And again, the way you pick the Keltner channel width is you want it to just touch the top of most of the primary uptrend bar so you get out just at the right time. Anyway, enjoy trading for a living.